everybody. Mike Loukas, CEO of TrueShares. Another episode of Off the Charts. Today, we're calling it the Dueling Beards. Today on Off the Charts. A good friend of mine, we go way back a little bit, David Brooks, founder of Retire SMART and SmartWay ETFs.
How we doing, Mike?
We're doing great, David. Good to see you.
Yeah, I think we, what was it, a couple weeks ago, I saw you, we were in the nation's capital, and we got to watch some political heavyweights from back in the day, James Carville and Karl Rove, have a little fireside chat on stage. That was kind of an interesting topic, which, I think it makes it interesting for the topic du jour. Today, we have a market that seems to shrug off any political noise, whatever it might be, job noise, whatever. And hey, the market dipped 3%. That's a buying opportunity. And away we go, right?
It's, and you and I have both been in the business long enough to have seen, several market cycles, right? And certainly downturns. We've seen some big ones, you and I. We've seen .com, we've seen '08, we've seen pandemic, we've seen some pretty chunky stuff. But I have never in my career seen a market that just seems to shrug off and maybe it's just a paradigm shift, right? Maybe what was news to us back in the day is no longer news to this market and in these market participants. I don't know. What do you think? Or is it just, we are just tone deaf and all we hear is AI, AI, AI?
Yeah. And I joke sometimes AI stands for artificial inflation of your stock price, right? I think AI is going to be an amazing tool long term, but, I love to study data. I love to study history. I think you can learn a lot from it. And it's this unique market right now where on the positive side, why you see the markets reacting, so you have earnings growth, that are pretty stellar right now, right? It's rare that we get 20, 25, 30% earnings growth estimates, and we're revising upward. Normally we're revising the other way. So from that standpoint, you're like, okay, but the reality is, does that stuff come to fruition? Recently I coined a phrase. I was like, hey, Mike, I've got no money, but you don't have any product, but I want the product when you get it, and I'll give you the money when I get it. So let's book a deal right now and call that sales this quarter. What do you say? And there's a little bit of that going on right now, right? It's a little crazy. So at some point the rug pull will happen. It always does. But I think that's what's unique is in the marketplace. I mean, gosh, it was a couple of years ago, but I had the pleasure of ringing the bell for one of your ETFs, the closing bell over in Chicago, right? Yeah. In the buffered space, which those have obviously done really well as a product in our industry. And we utilize those for what we call our defensive allocation, like 10, 15% of the average client. And we have a model with a bunch of buffered ETFs, different maturities and different drawdown strategies, et cetera. But I think that's the unique thing about the investment space today is because of technology, we're allowed to innovate products so much faster than we could have, when you and I started in this business back in the 90s. And when you had to take a 50% drawdown, you just had to take it, right? There wasn't things that you could protect yourself with near as liquid today. And of course, there's option contracts. I've been trading options a long time, but now you have 0-day options. That's new, and that means the VIX is priced differently. So some of the old ways that I would measure, when we're going to have a sharp pull down, well, they've been thrown out. And so you've got to always be adapting and adjusting.
Yeah, great. That's a great topic as well, right? Because it's information overload. Remember back in the late 90s, right before the .com burst, there were day traders, but they had to rent a seat, right? And they had to go to an office. And now you can just sit there in your sweats and your T-shirt with your laptop and have access to any markets you want 24/7.
Well, it's so funny because when that blew up, and those things always do, right? I had a neighbor. I remember when I was living in Florida, I had a neighbor that quit his job at a hospital making very good money and became a day trader. He did. He drove into one of those offices. You rent the cubicle, you make your deposit. But after that blew up, that's when we instituted this $25,000 minimum, right? You had to have 25 grand equity in the account to do more than 3-day trades period on your account or you were locked. Well, that just went away here recently, right? And that's the problem I see. I mean, you were talking about earnings markets, but now with Polymarket and Kalashi and all these other, they don't call it, gambling, but I mean, we have a culture of these poor college kids, they're betting on everything from, what Trump's next tweet will be, what the price of oil will be tomorrow, who's going to win the World Cup. I mean, it's a gambling addiction that's really scary to me, the way people are thinking the markets are more like a casino sometimes than an investment vehicle for the long haul. And again, I don't know what the rug pull will be, but there'll be some event, some point in our future that will straighten things out, and new regulations will come that will probably overreach again. But that's the society we live in today, right?
Well, I mean, it's the one thing we know is always true about the markets. Someone gets left holding the bag eventually.
Yeah,
Right.
absolutely. And I think it's a good point, because we're in an industry that has been aging for a while now. I have 46 employees at my firm here in Omaha, Nebraska today. We started this firm 8.5 years ago. So we've grown rapidly from just me, right? Really fast. We've gathered over $1 billion in assets in that time. And I'd say 3/4 of my employees have never worked in a real bear market. They've just not gone through the things that you and I have seen in our careers. But that's the same as these clients, these younger clients out there that are investing in these markets. And my goodness, how much money is going into these triple leveraged products and things that people are meant to hedge with or speculate, and they're betting the farm in these things. And I don't know. I think there's some ugliness on the horizon whenever that rug pull happens. I don't know. I'm not saying when it's going to happen. I mean, after all, Alan Greenspan, God rest his soul, he just passed away here recently about a week ago at 100, right? His irrational exuberance statement was in 1996. We went 100% up from that point over the next 3 years before the rug pull happened. So maybe we'll have Dow 100,000 before it happens. I don't know.
Yeah, and I remember that I was must have been 1998 or so. I was sitting on a Squawk Box call at CIBC Oppenheimer, and Henry Blodgett was the analyst covering Amazon at the time. And he got on the call and he said he put like a $400 price target on it. Not these days, $400 price target is okay, ho hum. Back then, we all went, uh-oh,
Yeah.
because we all saw it as sort of a bookseller at the time, right? An online bookseller. But you have those moments, and what I can't figure out is, and so you've got a pretty wide breadth of personalities to survey at your firm. So is it that they don't think it can happen again, or they think that they'll be able to trade around it, or see it coming, or like where's the blind spot here? Is it, oh, this can't happen again, or I'll see it coming? Like where do they trip up?
That's a great point. And at our firm, we got a lot of young advisors, but we have bumpers and guardrails. So like when I was a branch manager in the broker dealer world, I worked at one of the largest warehouses in the world. I started way back at a company, Payne Weber, that doesn't even exist anymore. But in that time, it was like the Wild Wild West with brokers. They each were doing their own thing. Like at our firm, everybody has to follow the same basic allocation kind of bumpers and guardrails. And you tweak it, customize it for each individual client. But it's a good point, because we do training every Monday and every Friday with all the advisors in our firm, because exactly, they've just never felt it. And it's, I just think it's one of those things, until you've experienced it as much as I can. It's like fatherhood, right? I can tell you all day long how the joys of being a dad, but the first time someone has, and we just had, we got a couple of my employees that are pregnant with their first kids now. When you put that first child on your chest, nothing I told you about it is real until that moment happens. Well, until you've gone through a 40+% correction that lasts over 12 months, you have no idea what I'm talking. I can describe it all day long, but it's just not real. So I think that's why, I encourage younger advisors in this business to work under experienced people, to get into a system and a place that has processes in place, proactively react correctly, so that I was pretty much still a rookie, a couple years in, and we had 3 negative double-digit years in a row in 2000, 2001, 2002. Man, that was painful. And so I did not experience that in 2008, 2009, because I learned what I was doing. I certainly lost money, and clients lost money in 2008. But I think my worst client was about 16% down in 2008, where I think the S&P ended that year around 37% down. So,
Yeah.
and drew down north of 50 before, it came back a little. So, but yeah, I just think unfortunately, you and I can talk to them and they're blue in the face. Until they've felt it, until they've experienced it, they'll respect it more. It's just, that, which is why, I believe mentoring, those below you is so important in industry, even for experienced advisors and solo practices. Find friends that are solo practitioners or younger you and guide them, help them, because clients need it, right? More than ever, because clients forget. I mean, it's nothing to have a 60-year-old walk in with $3 million saved for retirement now, but they forget that they had 700 grand saved in 2007 and it went all the way down to 300, right? They forget, but they've just had the sunshines and roses for 16 years. And they need to make sure they're allocating the risk correctly.
Yeah, no question about it. And that's one of my favorite. And I think our generation, we love the adages and the idioms and a lot of sayings, maybe more than they do now. But one of my favorite sayings was always, history may not repeat itself, but it sure as hell rhymes.
Oh,
And,
absolutely.
and so that's always in the back of my head. But hey, shifting gears from the markets for a second, because I know you're a great coach, of people in our business as well. And just when you coach other advisors, when you coach folks in our business, what are you prioritizing for them? Is it organization, or is it market approach? Is it all of that? What typically is your go-to lesson?
Well, I mean, what we start with is systems and processes. You've got to have processes for everything. So when we coach advisors that are smaller practices than ours and even larger than ours, how did you get there? And most business operators, if you're the entrepreneur, you want to scale, right? You want to make your business bigger, but you can only there's limited capacity in the roles you serve. And I learned that the hard way is trying to handle 350 household clients myself and still bring on new clients. It can become a train wreck from a service standpoint. So learning how to systematize and process orient everything. So, and then what we teach is taxes is typically the number one thing that most people are not really being trained on or taught correctly. And the tax code is actually written to lower your tax bill. There's over 1,700 incentives we have found in the tax code to lower someone's tax bill. And we focus on about 160 of them for our client base, which is either retirees and pre-retirees or high W-2 earners or business owners. Those are the three that we kind of work with, entrepreneurs that are growing their businesses. And we help them understand that the tax code can work to your favor, not just be a detriment, but you've got to understand it. And most people don't. And most accountants, and my little brother's CPA, and I have 4 accountants on staff here. Accountants are not typically trained to be proactive in nature. So you have to put a process in place for that. So we do a lot of coaching around how to learn how to talk taxes, how to develop relationships with CPAs. If you can't have them in your firm like we do, we can teach you how to develop those relationships. We coach advisors to that. And then when it gets to the asset allocation part, I certainly show them my philosophy, but every advisor seems to have their own kind of philosophy when it comes to how to allocate client dollars. I think Ray Dalio is one of the smartest people around long term, and so we kind of follow that. We typically have 20 or 30% of someone's assets in risk-free assets. That could be cash, fixed annuities, MYGAs, treasury bills, things that are really can't lose any value, right? And you can get access to liquidity if you need it, have the right amount there. That next 10 to 15% we typically use, I was speaking about earlier, some kind of defensive portfolio. And where we used to do sophisticated options, now we can buy a simple buffered, ETF, or we buy a selection. We have like 16 in our portfolio. So varying, drawdown numbers, et cetera, to balance. And then it allows us then our core allocation, which is close to about an 80-20 traditional mix. And I split that half active and half passive. And then we have what we call our alpha portfolios on the top to create the alpha generation on top. And that's good old fashioned stock picking. It's not using leverage. It's not using options. It's just, hey, can I pick better stocks than the market itself? And, track record, I believe says that the answer is correct, but, obviously, can't talk performance.
No, never. So, like David, it's coming up on 10 minutes. I always promise the audience we'll keep it under 10. About 1,000 things we could have covered, so we'll try that again next time we chat. But I do want to let people know that they can always find you and chat with you themselves. So and I know you've taken some of your strategies and put them into ETFs as well. So I think it's Retire SMART and then SmartWay ETFs. If you want to just lob out how people can find you online, we'll tie it off with that.
Sure. RetireSmartNow.com is our main website. And the ETFs, if you want to look them up and look at what we've done there, SmartWay ETFs, plural S.com, SmartWayETFs.com.
Awesome. Great to talk to you, David. Thanks for
Hey,
taking the
great
time.
chatting with you, Mike. We'll talk to you next time.